Every personal finance teacher, every motivational poster, every retirement calculator starts with the same exact line. Compound interest is the eighth wonder of the world. They attribute it to Einstein. They put it over a snowball rolling down a hill. They tell you to invest early, let your money grow, trust the math. And here is the uncomfortable truth about all of it. That version of compound interest, the one you already know, is the least powerful version of the concept. It is the surface, and people who only understand the surface arrive at 60 with a fraction of what the math promised. There is a second layer almost no one explains. Not the teachers, not the calculators, not the inspirational posts. It is not complicated, but it operates in two directions simultaneously, building your wealth and quietly destroying it. The direction it moves faster depends entirely on a single decision most people never consciously make. I want to show you exactly what that decision is. Two people, real numbers, math you can check yourself. Here is the claim. Most people understand compound interest the way you understand a car by knowing it has an engine. Technically correct, completely insufficient for what actually happens on the road. The version you have been taught, invest early, earn a return, watch it grow, describes the mechanism. What it does not describe is the shape of how compound interest moves through a real financial life. A real life where income comes in, debt accrues on the other side, and decisions interrupt the math in the middle. A timeline that is not the clean 40 years the poster assumes. A journey almost no one actually finishes undisturbed. The people who understand the shape make decisions that look strange from the outside. They pay off certain debts before investing. They choose a slightly lower return in one account to unlock a better position somewhere else. They do things the inspirational post crowd calls wrong, and they end up with dramatically more money at the end. The difference between the two groups is not discipline. It is not income. It is not how early they started. It is one number almost nobody calculates before making their biggest financial moves. By the end of this, you will know it. Before we get to the number, we need to be precise about what people mean when they talk about compound interest. There are two camps, both of them are right about part of it. Both are wrong about the part that matters most. The first camp is the time camp. These are the people who lead with the early start argument. Invest at 22 instead of 32 and retire with twice as much. The math behind this is real. It is powerful. If you invest $5,000 a year starting at 22 at 7%, you will have approximately $1.1 million by 65. Start that same investment at 32 and you will have approximately $567,000. Same contribution, same rate, 10 years earlier. The difference is $574,000, more than the second person ever invested in total. The time camp is not wrong, but the time camp makes one quiet assumption it almost never says out loud. It assumes the rate stays constant. It assumes you do not touch the money. It assumes the 40-year journey is clean. For almost no one is it clean. The second camp is the rate camp. These are the people who argue that chasing a higher return is what separates the wealthy. Move from a 7% return to a 10% return and retire with dramatically more. This math is also real. That same $5,000 a year at 10% starting at 22 becomes nearly $3 million. More than double the outcome. The rate camp is not wrong either. Rate of return is one of the most powerful levers in the entire equation. But the rate camp makes a quiet assumption it rarely names. It assumes higher returns are available without meaningfully higher risk. It assumes you will hold through a 40% market crash in year 12 without panic selling. The research on what actual human beings do in actual market downturns is not flattering to this assumption. The average equity fund investor, according to decades of behavioral data, earns meaningfully less than the fund they are invested in. They move money at the wrong times. This is not hypothetical. Decades of fund flow data have confirmed it. So here is where both camps have been talking past each other for decades. The time camp ignores rate.x. The rate camp ignores behavior. And neither camp has much to say about what is working against compound interest on the other side. The other side of your balance sheet, every single month. Whether you are investing or not, that thing is debt. And that is where the real math begins. Meet Jordan and Taylor. Same income, same age, same financial starting point. Both are 28 years old. Both have $800 a month they can direct toward their financial future. Both carry identical debt, a single credit card. A $6,000 balance sitting at 19.99% interest. The only difference is what each has been told. Jordan heard the time camp's message: start investing now. Do not wait. Time in the market beats timing the market. So Jordan opens an index fund, puts $800 a month into it, and pays only the minimum on the credit card. Approximately $120 a month. The balance slowly shrinks. The investment account slowly grows. The math is running. Taylor heard something slightly different. Taylor understood that compound interest runs in two directions, not one. So Taylor puts every dollar of that $800 toward the credit card first. Stops investing completely for 9 months. Clears the credit card entirely. Then redirects the full $800 plus the freed minimum minus $920 a month into the index fund. The time camp would look at Jordan and say, more months invested, more time compounding. Jordan clearly wins. Run the actual numbers to age 65. Jordan invested for 37 years at $800 a month at a 7% annual return. That produces $1,626,344. But Jordan also carried that credit card on the minimum for 9 months, accruing for $117 in interest before clearing it. Taylor invested for 36 years and 3 months at $920 a month at the same 7%. That produces $1,698,219. Taylor started 9 months later, invested for less time, and ended up with $71,875 more than Jordan. Not because Taylor found a better investment. Not because Taylor earned more money. Not because Taylor got lucky. Because Taylor understood that compound interest running against you at 19.99% is not a footnote to the wealth building equation. It is the equation. That is the second direction. And here is the 30-second principle hiding inside that result. Every percentage point of interest you are paying on debt is a guaranteed negative return on that same dollar. A 7% investment return and a 20% debt interest rate do not cancel each other out. They compound in opposite directions simultaneously. The negative side at 20% is compounding almost 3 times as fast. This is the part the inspirational poster never shows you. The snowball rolling uphill at the same time as the one rolling down. That first case was the contained version. One debt, one investment account, a clean 9 months. Real financial lives are not that clean, so let me show you the same principle at the scale most people actually operate at. Because the gap in this version is not $71,875. Same to people. Now they are 28 with a more realistic debt picture. Jordan and Taylor each carry 3 things. A credit card with an $8,500 balance at 22.74%. A car loan of $14,000 at 8.4%. A student loan of $27,000 at 6.54%. Each has $1,100 a month to work with above their minimum payments. Here is what each person does with it. Jordan invests the full $1,100 immediately, pays minimums on everything. Lets compound interest work, trusts the time camp. Taylor does something that looks, on the surface, like a mistake. Taylor stops investing entirely for 26 months. Taylor pays down the credit card and car loan aggressively, highest interest rate first. Nothing goes to the index fund. Only after both are cleared does Taylor begin investing, now with $1,374 a month going into the account. That extra $274 a month comes from the minimums that were freed when those 2 debts disappeared. At 65, here is what the numbers say. Jordan invested for 37 years at $1,100 a month at 7%. That produces $2,237,223. But Jordan paid $12,841 in interest above the minimums during the years Taylor was clearing those debts. Because Jordan never cleared them aggressively. That interest cost is gone. It does not come back. It is not recovered. Taylor invested for 34 years and 10 months at $1,374 a month at 7%. That produces $2,619,507. The gap is $382,284. Let that number sit for a second. Jordan did everything the time camp told them to do. Started immediately, never missed a month. Stayed consistent for 37 years. and still arrived at retirement with $382,000 less than someone who waited 26 months before ever buying a single share. Because compound interest does not care about your intentions. It does not reward you for starting early if you are simultaneously feeding a 22% leak. The shape of your finances matters more than the start date of your investment account. That is the lesson hiding in the numbers. There is a third cost neither Jordan nor Taylor paid in my examples, because I built them as perfectly disciplined people. They never flinched, they never sold, they never panicked. Real people are not perfectly disciplined. Real people flinch. In 2008 and 2009, the S&P 500 fell approximately 56% from peak to trough. Investors pulled hundreds of billions of dollars out of equity funds during that period. The people who sold locked in the loss. The market recovered and went on to deliver one of the longest bull runs in history. But many of the people who sold never fully got back in. Or they got back in late, or cautiously, missing most of the recovery. Studies tracking actual investor behavior, not hypothetical investors, actual fund flow data, consistently tell the same story. The average investor underperforms the average fund they are invested in by somewhere between 1.5 and 2% per year. Not because of bad funds, because of behavioral decisions made during volatility. Buying high, selling low, staying out too long. On a 37-year timeline at $1,100 a month, the difference between 7% and 5.5% is not a rounding error. At 7%, the outcome is $2,237,223. At 5.5%, the outcome is $1,497,366. The behavior tax is $739,857. Not from bad investments, not from bad timing. Purely from the gap between what the market returned and what the investor captured. The math is not the hard part. Staying in a position where the math can work, that is the hard part. The single most reliable predictor of whether someone stays invested through a crash is how much financial pressure they carry from the other side. People with high debt loads and no emergency buffer are the most likely to sell during downturns, because they have to, or because the psychological weight of watching a portfolio fall while minimum payments arrive every month is more than the investment thesis can hold. Debt does not just cost you the interest, it costs you the behavioral stability that compound interest requires to actually work over time. Both camps have been arguing about how to invest. Neither has asked the more powerful question first. Before you decide how to invest, ask whether you can change the environment your investments are operating in. 3 moves exist that sit above the entire invest now or later debate. Each of them amplifies compound interest rather than simply directing it. The first is employer match capture. If your employer matches for 101k contributions up to a percentage of your salary, that match is extraordinary. It is a 50 to 100% instant return on those dollars before compounding even begins. No investment on earth reliably delivers that kind of return in year 1. Capturing the full match before anything else is almost always correct. The one exception is debt above approximately 18 to 20% interest, where the compounding against you outpaces even the match math. The second is tax-advantaged account sequencing. A Roth IRA compounds your returns and lets you withdraw them entirely tax-free in retirement. A traditional 401k defers taxes, reducing your taxable income today. The difference between these accounts and a taxable brokerage compounds enormously over time. On the same contributions at the same return over 35 years, the tax drag difference can exceed $200,000. Most people pick accounts based on what they heard first. The correct sequence is almost never the one people are actually operating in. Employer match first, then high-interest debt. Then Roth IRA up to the annual limit, then back to the 401k, then taxable brokerage. That sequence is not complicated, but it is almost never the order people are naturally following without being told. The third move is fee reduction before payoff strategy. A 1% annual fund fee versus 0.04% sounds like a rounding error. Over 40 years on a $500,000 portfolio, it is the difference between $742,000 and $981,000 in ending value. The fee compounds against you in exactly the same way debt interest does. Lower the costs before optimizing the order. With all of that on the table, here is the actual framework. 3 cases. Find the one that matches your situation right now. Case 1. You have no high-interest debt, a full emergency fund, and you are not capturing your full employer match. This case is the clearest of all three. Capture the full employer match first. That action is correct in almost every scenario. Regardless of market conditions, rate of return, or investment vehicle, the match eliminates the timing question. Every uncaptured dollar is a guaranteed loss. Case 2. You have consumer debt, but all your rates are below approximately 7 to 8%. Here the math becomes a genuine close call. At 6% debt versus an expected 7% investment return, the spread is thin. Behavioral factors and account type probably matter more than the pure payoff versus invest calculation in this narrow band. A parallel approach, minimum extra payments on the debt while contributing to tax-advantaged accounts, is defensible and often slightly optimal. The cost of staying completely out of tax-advantaged accounts for years to eliminate 5% debt is often larger than the interest you save. Case 3. You have high-interest consumer debt above 10%, and you are investing beyond the employer match in a taxable account. This is the shape that costs real money. Every dollar in a taxable account earning 7% while 22% compounds in the background is a net negative position. You are not building wealth in that scenario. You are running in place with a weight attached. The order of operations matters more than any investment decision you make this year or next year. Clear the high-interest debt first, capture the full employer match. Fund the Roth IRA, then invest freely. That sequence is not a sacrifice. It is compound interest, properly directed in the right direction. There is one honest complication to case 3 that deserves its own answer before we close. Some people know, with certainty, that if they stop investing completely to pay down debt, they will lose the habit. The contribution gets cancelled, the momentum breaks. 2 years later, when the debt is gone, the investment account is never reopened. That is not a theoretical risk. It is a well-documented behavioral pattern. And it matters more than the pure math in those cases. If that is you, if you know all or nothing is a losing approach for your specific psychology, there is a hybrid sequence. Pay the minimum on the debt, contribute enough to your 401k to capture the full employer match. Then split the remainder, 70% to the highest rate debt, 30% to a Roth IRA. Run that split until the high-interest debt is gone. When I ran this hybrid against the pure strategies, the outcome sat almost exactly between the two. It costs approximately $41,000 more by retirement compared to the pure debt-first approach. It costs much less than never restarting at all. But it protected the investment habit, the tax-advantaged compounding window, and the behavioral continuity the entire timeline requires to succeed. $41,000 is not nothing. But it is the price of keeping yourself in the game when the alternative is quitting. A plan you actually finish, at nearly the optimal outcome, beats a theoretically superior plan you abandon in month 14. Once the high-interest debt is cleared, the split ends. The full amount flows into investment accounts. No more compromise. One phase of concession, then rate order, then full investment. That is the sequence most people in case 3 actually need. Here is the thing to carry out of this. Compound interest was never really just a math concept. It was always a description of direction. Money moving in a direction, consistently, over time, compounds. That is the entire mechanism. There is no magic. There is no eighth wonder. There is only direction, consistency, and time. What the inspirational poster gets wrong is the implication that the direction is fixed. That investing is the direction and everything else is noise. Your financial life has two sides. On one side, compound interest is working for you. On the other, it is working against you. The side it works harder on is determined entirely by the interest rates involved, not your intentions, not your discipline, not your start date. The people who build real wealth are not the ones who found a better investment. They understood the full picture, both directions, both sides of the balance sheet. The actual math, not the simplified version of it. Jordan did not fail because they were undisciplined. Jordan failed because no one ever explained the second direction. Now you know both. The question is not whether compound interest is powerful. It is. The question is which direction it is moving faster in your life right now. For the majority of people carrying high-interest debt while investing in taxable accounts, it is moving against them. And they do not know it. Knowing which situation you are in takes 5 minutes and one honest look at your balance sheet. That is the only number that settles it. I told you at the start that most people understand compound interest the way you understand a car by knowing it has an engine. I hope what you have now is closer to understanding the road. The mechanism is simple: direction, consistency, time. The shape is what separates the people who arrive with what the math promised from those who fall short. The three cases give you the framework. The hybrid gives you the behavioral escape valve for those who need it. The order of operations: match capture, high interest debt, Roth IRA, 401k, then taxable brokerage, gives you the correct sequence to follow. Your numbers are not Jordan and Taylor's numbers. Your rates are different. Your balances are different. Your timeline is different. The only figure that truly settles which case you are in is the one you calculate on your own balance sheet. If this gave you clarity on a decision you have been making on instinct, subscribe to Wealth Insider Build. Every week I break down the math behind financial decisions in plain language. Real numbers, no inspirational snowball posters.